Hello and welcome back to All Things Money. My name is David Blain, your host for the show. And during the first segment, we were talking about the dreaded tax audit and how about 78% of audits are done by mail now and not in person. And when we left off before the break, I was mentioning that a lot of the forms in the paper that they send people is still very confusing and intimidating. And so a lot of taxpayers still prefer to deal by phone or in person. And so they get the audit and they pick up the phone and they call the IRS to try to figure out what they're talking about. The Taxpayer Advocate Service is a subsection within the IRS that's supposed to advocate. It's like an independent agency that advocates for the taxpayer. And so they routinely look at these things, and they had a sample of 754 taxpayers who claimed the earned income credit were audited. And more than a quarter of them had no idea they were being audited, and 40% didn't even know what the IRS was asking them to provide. Now, the earned income tax credit is something that lower income people are eligible for, and this just points to the fact that a lot of these people, they don't even understand that they're being audited, or they don't know what the IRS is asking for. And so that is a problem that they're trying to address, but the paper audits are still the preferred method for the IRS to conduct these audits. It's just simply cheaper. It takes less resources for them to do. And as I said during the first segment, I would prefer a correspondence audit any day. It gives you time to assess what the IRS is asking. They're usually very specific. It gives you time to draft a specific response letter and send them the documentation that they need. Whereas if they're in person, sometimes the client can get flustered or nervous and things like that. So we like the correspondence audits. So let's move on to another topic. I wanted to talk a little bit today about supply and demand. This is one of the things that you hear me talk about a lot in the marketplace, whether you're buying a car, whether you're buying a loaf of bread, whether you're buying jewelry, some luxury item, a home, and the stock market, the bond market, the commodity market. In any transaction of goods and services, it's simply an equation of supply and demand. If you go back all the way to Econ 101 that you had maybe in college or high school, I don't know if they teach economics in high school today in normal schools, but back in college you learned about Econ 101, the supply and demand curves. That's what it all boils down to. If you look at the real estate market today, you have an oversupply of housing, and so that drives the cost down. You have a supply curve and a demand curve, and where the two meet is where the price is. 8-9 years ago, you had a huge demand for housing, and the supply could not keep up with the demand, and so the price kept going up. Today you have the opposite. There's way too much supply for the demand, and so the prices come down. This is a basic scenario. Now, government involvement, things like that, can affect the supply and demand curves by shifting them. But when it comes down to it, it's still a supply and demand. That's what happened by the government subsidizing mortgages, encouraging home ownership. They affected the supply and the demand curve. But at the end of the day, it's still a supply and demand curve that will set the price of things. Even in medicine, when you have the government involved with so much, Medicare and Medicaid, you have you're creating a lot of demand for that product. People that don't have to pay for it, someone else is paying for it, raises the demand for those services, which if the supply can't keep up, the price accelerates. So even when you have government controls, rent controls, price controls, subsidies, everything still operates on a basic supply and demand curve. And that it holds true for the stock market. We can analyze the fundamentals of Coca-Cola. We can analyze the GDP of China and interest rates and all this macro factors and fundamental factors of companies. But when it comes down to it, when that share is listed for sale on the New York Stock Exchange or the NASDAQ, or the electronic trade, it's all electronic now, but when someone says, I want to sell my shares, 100 shares of Coca-Cola, it comes down to they're supplying 100 shares. What is the demand out there for 100 shares? And if there's a lot of demand, then they can afford to get a higher price. If there's no demand, then the price will be set much lower than may or may not be indicated by the macro factors, the fundamentals. I tend to believe that over long periods of time, the price on average will equate to its fundamentals. But in the short term, it's a pure supply and demand equation, and that things can be out of balance for a long time. And so when analyzing markets or stocks, it's very important that you take a look at the supply and demand curve for that particular asset that you're trying to buy. Unless, of course, you just don't care and you say, well, Coca-Cola is worth, $50 a share and it's on sale, for $40 a share, and you buy it, hoping to hold it for, 10, 15, 20 years, hoping that the price will at some point, the demand for it will rise to its fundamental value. But if there's no demand for it and you pay $40 for it, it could continue to go down. But at the end of the day, it's all about this supply and demand equation. We're coming up on our second break for the show, so I'm going to pause here. When we come back after a few short messages, we'll continue this discussion about supply and demand in the stock, bond, and commodity markets. So for All Things Money, I'm your host, David Blain, and we'll be right back after a few short messages.